makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Brent crude hitting $95 a barrel for the first time since November. Chevron CEO says 100 is in sight. And stocks wavering as traders brace for a hawkish tone from major central banks. The Federal Reserve kicking off its two-day meeting starting today. Plus, Santander revamps its structure, a move that could lead to job cuts as the bank's new CEO looks to simplify its operations. Now let's take a quick look at how European markets are trading here, because you are seeing a little bit of a mixed picture. Remember, as we talk about central banks broadly, you are going to see a little bit of a tone of caution. And I think that's what's interesting here. As we see, yes, green on the screen, but not that much. Remember, volume is going to be a little bit lower. Again, everyone kind of on the back foot rather than these massive positioning you're going to see going into the Fed tomorrow, the BOE, and then, of course, the BOJ, not to mention the slew of central banks around the world. Right now, your outperformer is actually in the FTSE MIB right here. That's where you're seeing Italy outperform by 0.4%. The underperformer is going to be in some of those smaller markets as well, but I think the UK is where we want to focus in on, because that's where you're seeing only gains of 0.2%. Yesterday, remember, the turnaround was that the FTSE 100 actually underperformed the broader continent, so it's interesting to see the dynamics still in play this morning. I want to go abroad, though, across the Atlantic and talk about the United States, because the S&P 500 is really going to be in focus. Take a look at this one-year chart. It feels like a one-way direction, really a one-way road, if you will, starting to see a little bit of that momentum come off. And that's going to be significant as we talk about what are the lags that the Federal Reserve perhaps isn't talking about. And that's significant, again, simply because we are talking about the idea that a lag could start to take in place later. Economic data could then deteriorate, and that could weigh on the S&P 500. It feels like that sentiment already showing up, which is why that peak in July is already coming off. Let's go again across the Pacific, a journey around the world, if you will, and talk about the other major decision, the game changer, which could be this week, and that, of course, is the BOJ. The yen swaps is interesting here, because if you take a look at the FX story and the bond yield, markets are already pricing in that this Friday is going to be one for the history books. Perhaps Governor Ueda is actually going to be talking about maybe getting off that negative interest rate policy. Now, it does feel a little mind-boggling to perhaps get there, but that is not stopping those FX traders and bond traders from pricing that in. Do they deliver? Do they finally actually deliver on that shorting JGB trade, which is apparently something that people are still betting on? I want to end it here with actually something the BOJ, the Federal Reserve, and central banks around the world are going to be talking about, and that is Brent crude. Take a look at this 5-year chart. Now, over 5 years, it doesn't really look like that much has happened, but I promise you it has. Remember when 2019 we were talking about those tariffs and simply China-U.S. tensions? We go down into the pandemic, we recover massive demand all the way into 2022, and that's when we start talking about the supply crunches that you were seeing come out of OPEC and, of course, the deteriorating Chinese economy. Now, it's less a story of demand, more a story of supply. Those tighter markets you were seeing in physical crude, that's where you're seeing the pain, pushing the market higher. Once again, do we hit $100 a barrel? What does that do to the U.S., especially, by the way, going into a presidential election next year? Now, that's going to be significant, and that's where I want to start such a crucial markets conversation this morning. Joining us now to dive into it is Maya Bhandari, BNP Paribas Asset Management's Global Head of Multi-Asset. She joins me right here on set. Thank you, as always. You picked a great day to join us because commodities are all the rage, and in 2021, it was a really easy trade. You buy your regular portfolio, you get a basket of commodities, you throw it all into a bundle, and boom, you're hedged. Does that trade work again?
As I think you just reflected, commodities and particularly oil have moved quite a long way in recent weeks. Now, you're right, commodities, you could almost shut your eyes last year, and it didn't matter which commodity you'd invested in. It gave you a positive return in a year where every other asset class gave you negative returns. That's, of course, not the picture this year, although commodities certainly have risen. To us, it's really a supply-led story, and frankly, one we benefited from because we've been long of commodities in BNP PAM asset allocation portfolios for much of this year. And that's, if you will, helped us in a world where I guess you've had a lot of narrative volatility, if you like.
I love that you called it that, a narrative volatility, though, and that's really interesting because if you talk about what's actually pulling the market, I'm going to nerd out for a second. Bear with me, Maya. We'll come back to the markets, but the geopolitics is really interesting here simply because we talk about the Saudis really driving these OPEC decisions, even Vladimir Putin to some extent becoming a part of it. So to really price in the oil market and inflation broadly, if it indeed is led by commodities, you kind of have to be in the mind of the decision makers in Saudi Arabia. From an asset management perspective, how do you price in that volatility? How do you hedge it when really it's kind of hard to predict what's going to happen next?
Well, I would, as an asset allocator, I'd sort of look at commodities in a broader portfolio construction context. So I'd be thinking about commodities in context of equities, various flavors of fixed income, currencies, bonds, and so on and so forth. And so, as we reflected earlier on, I think commodities have actually given you a little bit of diversification this year. Certainly gave you a whole lot of diversification last year. Now, I think when I think about commodities, say earlier this year, in another period of narrative volatility, commodities were really priced quite bearishly, whereas equities were rallying quite hard earlier in the year. Commodities were quite soft and really seemed to be much more in the recession sort of narrative than the overheating or Goldilocks narrative. Today, of course, commodities have risen, and oil in particular has risen quite nicely. But I think and particularly this week, I think what's really interesting to probe as well is how higher commodity prices alter that Goldilocks narrative that has been all pervasive in markets, and we see that when we look at cyclicals, we see that when we look at bond yields, and to our minds, it really impacts, if you will, more the growth side of the Goldilocks equation than the inflation side of things. Over the long term, precisely for the reason that you suggest. This is really a supply-led story to our minds.
You said it beautifully, because one of my favorite charts is actually if you overlay oil and bond yields, they're not tracking each other the way they have for the last 5 years or so, which, to your point, illustrates that perhaps this isn't a commodity-led market. This is really the focus is back on growth. So let's put our central banking hats, if you will. Tomorrow's the Federal Reserve decision, BOE on Thursday, BOJ on Friday, not to mention a slew of others around the world, in case you really were missing the central bank's action. If you're Chair Powell, what do you do right now?
Well, I mean, I guess if we start off with where the ECB left things last week, I guess we had, to our minds, a dovish and final hike from the ECB. Look, I mean, I think our expectations, like I think most people's expectations for the Fed this week is it stays on hold, leaves the door open for a November hike, but in our view is very unlikely to use that option, quite simply because we see, the 525 beeps of hike that have already are coming through the U.S. economy, starting to belatedly impact growth, impact the labor market. And so, I think, as I said, I think the downside risks to growth, to our minds, are a bit more pronounced than the upside risk to inflation right here and right now.
Well, I'm glad you said that. 525 basis points of hikes echoing through the markets. I mean, they're calling it a hawkish pause is what we're going to hear, which, again, I still don't know what that means, because that could be interpreted a million different ways. Talk to us a little bit about the impact on the equity markets here. We saw a taste of this, I want to say, from the ECB and the ripple effects throughout Europe, and then the pushback, I should say, from the fiscal governments across the continent. But in the U.S., if you were coming off a really horrible year, by the way, in 2022 for the equity market, and you were talking about this delayed or this lag coming from these 525 basis points that you just talked about that hasn't quite hit the economy yet, do you then see, and I'm kind of just thinking out loud here, do you then see the economic data deteriorating and, by extension, the stock market deteriorating? Or is it all priced in from 2022?
So I'd say no, it isn't all priced in from 2022, but I'd say more broadly, I'd boil down equity market returns into cash flows and discount rates, right? Those are the two drivers, and I'd say today, I think both are in the wrong place, if you will. So I think certainly on the earnings side of things in the U.S., earnings expectations have actually increased recently, and so for the S&P 500, we're looking for 12% earnings growth next year, 11.5% the year after, high single digits in Europe. And none of that, to our minds, is consistent with that picture of weakening economic activity. I mean, let's not forget, in times of weaker economic growth, as we are starting to see, normally earnings expectations fall by 10, 15%. They certainly don't rise by that sort of magnitude.
It's a really tricky situation. I keep saying this over and over again. You could not pay me to be Chair Powell right now, or frankly, any leader of a central bank. Maya Bhandari, we thank you as always. She joins us, of course, from BNP Paribas, Global Head of Multi-Asset Strategy. We thank you as always. Now, coming up, our exclusive interview with the Global Head of AXA IM's Alternative Business Unit, managing nearly $200 billion worth of assets. We're live in Paris at the EPAM conference. Stick with us. This is Bloomberg. Welcome back. This is The Pulse. I'm Kriti Gupta filling in for Francine Lacqua. As central banks around the world meet this week, what impact has rampant inflation and the pretty steep hiking cycle had on private equity? Bloomberg's Danny Berger, who's at the EPAM Private Equity Conference in Paris, standing by with a guest. Danny.
Kriti, thank you so much. That's right. I'm here in Paris at EPAM. Pleased to say I'm joined now by Isabelle Scemama, who, of course, is the global head of AXA IM Alternatives. Isabelle, thank you so much for joining. A pleasure to speak with you today.
Thank you for the invite. Good morning.
Look, AXA IM, the alternatives business, it has a lot under its umbrella. You have real estate, you have debt, you have infrastructure, you have private equity. In this era of higher rates of economic concern, what is the most popular? What is the most in demand of your products?
Definitely those who offer good protection, notably against inflation, against interest rates. So I will mention two. Everything that is private debt, because generally private debt is indexed on floating rates, and also infrastructure because of the underlying trends and inflation indexation. So
yeah, everyone is really excited about private credit. You know, the golden age has kind of been thrown out there, but I wonder what pressure that puts on other portfolio managers when you have credit that can deliver, you know, low double digit, but double digit returns. What does that mean for private equity then, in turn, if you have an asset class that is outperforming so much?
It means that cost of funding have increased, that's for sure. That's why there is such attraction around everything that is private debt. And that also benefits from the banking disintermediation. So there is different trends that are supporting private debt. When you are looking at the other asset classes, notably you've mentioned private equity, but also real estate, of course, there is some pressure and valuation pressure.
Right, and of course your largest chunk of offering is real estate. I mean, there's been plenty of concerns around real estate. When it comes to commercial real estate, and as work from home still lingers, how are you evaluating risk right now in the portfolio?
But it's for sure that the office market is under pressure, probably more in the US than in Europe because of this work from home and the oversupply. But for us, real estate is a very large range of underlying assets. Office only represents less than 30% of the real estate portfolio we manage. So we have invested notably in residential, in logistics, and a lot of alternative asset classes within real estate that are performing very well. So, of course, the office market is what is on the headlines. It's generally the big bulk of allocation for a lot of investors, but we've managed to diversify and to reduce the quantum of offices.
Do you buy this thesis, though, of a doom loop, of an office real estate? You have more defaults, it puts more pressure on central banks, and the cycle kind of goes on and on. Is that a realistic outcome?
I think even when you look at the office market, that is for sure under pressure, and there is refinancing that are at risk under pressure because of too high leverage. But nevertheless, we have also to, when we look at the office market, to look at the differences between what we will call the stranded assets and the prime asset. If you look at here in Paris, the prime asset are reaching level of rents that at record high, very high level of rents, because there is a real scarcity of the best assets. So even within real estate and within the office segment, there is really a lot of different things.
And when it comes to real estate, one investment that really caught my eye, it was just earlier this year, just in the summer. You bought a French film studio and production space. I know it produced films like Marie Antoinette, one of the Hunger Games. What is the thesis of buying a film studio space? It's such an interesting one.
But the thesis is very simple. It's, you have such demand for content from all the big Netflix and so on that this sector is benefiting from a lot of demand, so good cash flow, good potential growth. For me, it's exactly the same thesis that we had when we have invested in data centers, when we have invested in life science building or in student accommodations. All those asset class that benefit from strong growth because of the underlying demand. And so, yes, the objective, of course, studios are more glamorous for sure, but yeah, the thesis is really about growth and potential.
I was going to say, when do we see the AXA IM documentary coming out? You give them a little wink, wink, nudge, nudge. How does the Hollywood actors strike play into that? Because there might potentially be this period without content because of that. Does that change anything for you?
No, because yes, here we are playing in France with a French studio, so we are not impacted by what's happening in Hollywood, and there's still a lot of demand from, it's not just the big US platform, but also the European players, and there is the new demand that is coming thanks to the internet, but also more and more production is made within studio instead of outside. The film, they want to go in studio because it's cheaper, it's easier, you don't have to deal with the weather, so it's far more efficient. So you have a transfer from the historical production that is going more and more in the studio and more demand. So
do you grow that then? Do you want to do more bolt-on acquisitions? How prime is this space for private capital?
I think the way we are looking at it, it's exactly what we have done with other platforms, is we leverage on our development capabilities, on our capability also to manage private equity and teams and to operate those ecosystems. So the idea is to grow and to aggregate, maybe with other acquisition or developing and refurbishing and adding capex to maintain and to upgrade the quality of those studios. So it's a mix of growing organically and inorganically.
Now, Isabelle, before I let you go, AXA has an interesting structure because, of course, you're born out of a specific company that's not necessarily private capital. We've seen that happening more, be it insurance, be it with big funds. PGIM, for example, comes to mind. We've seen more people, even banks, adding on more private credit and private capital in general. What does the competitive environment look like for you right now?
Well, I think with the volume of AUM we manage, close to 200 billion euro, we are the biggest or one of the largest in Europe in an environment that is mainly dominated by American players. So we have this European DNA, and probably the way we play competition is being, I think, very credible in everything we do regarding climate change, decarbonation. Yeah, we are definitely, I think, leading, notably thanks to our real estate platform. Real estate, it's 40% of the green gas emissions. So we had to be ahead on this, and I think that's the way we position ourselves, having very strong convictions and also capabilities on addressing this carbon story.
Well, a good place to end it on a European note here in Paris. Isabelle, thank you so much for joining. A pleasure to speak with you.
Thank you very much.
Kriti, that was, of course, Isabelle Scemama of AXA IM Alts.
Bloomberg's Danny Berger in Paris there with that exclusive interview. We thank you as always. And still, with more to come from EPEN, an exclusive interview with Blackstone Chairman and CEO Stephen Schwarzman coming up at about 10 a.m. UK time, an interview you do not want to miss. Coming up on this program, we're going to talk about oil a little bit. $100 a barrel on the horizon. Do we get there? More on the outlook next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lacqua. We are getting some headlines here on the internal shakeup within BP, British Petroleum. Kate Thompson named the interim CFO there. She, of course, has had several pretty senior financial roles, including being group treasurer and the head of group tax, that according to a press release coming out from British Petroleum. We, of course, will keep an eye on that and give you more developments as we get them. For now, though, I want to broaden out a little bit, get a little bit more analysis on the market broadly, and talk about oil getting closer and closer to $100 a barrel, hitting 95 just earlier in today's session. Bloomberg's Will Kennedy, senior executive editor for all of our commodities and energy coverage, joins us right here. Will, $100 on the horizon. Chevron CEO said it himself. How do we get there? Whose court is the ball in?
Well, a lot of people are talking about $100 now, as you say. I think it's a reflection of the fact that clearly we can see that supply is going to be constrained until the end of the year, because Saudi Arabia and Russia have said they will keep those cuts in place. Meanwhile, we're seeing a little bit of a pullback in growth from the shale fields in the US, and demand globally, for the time being at least, remains very robust. So we're seeing tension throughout different parts of the oil market. If you look at the price of oil now versus the price of oil in the future, it's showing there's a lot of demand right now. If we look at demand for actual physical barrels rather than the futures prices that we track day to day, that's very strong. And if we look at refining margins reflecting how much stress is being put on the refining system to turn that crude oil into fuels, again, signs that a strong market. So you put all that together, and it's not a surprise that people like Mike Wirth, the Chevron CEO, say that they see $100 on the horizon. How long it takes, well, that will depend on the day-to-day ups and downs of the market, but clearly a lot of people see it as a possibility as we go into the winter demand season.
A lot to digest. Will Kennedy, I wish we had more time with you. There's so much going on in the oil market right now. If that, of course, the bull case you outlining with the Saudis and essentially this physical tightness that you are seeing in the markets. If there's a bear case to it, too, simply that the demand, the robust demand that Will Kennedy was just talking about, pulls back more substantially. But right now, again, the focus all about supply, as he just pointed out, something we're going to be watching very, very closely. Coming up, we're joined by the chief executive of Entain as Morgan Stanley resumes its overweight recommendation on the UK-based gaming company. That interview next. This is Bloomberg. Brent crude hitting $95 a barrel for the first time since November. Chevron CEO saying 100 is in sight. Meanwhile, stocks waver as traders brace for a hawkish tone from central banks around the world. The Federal Reserve kicking off its two-day meeting today. Plus, Santander revamps its structure, a move that could lead to job cuts as the bank's new CEO looks to simplify its operations. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. We'll start there with Santander. Shares flat after Spain's biggest bank revealed an overhaul to its corporate structure in a move that may involve job cuts. Bloomberg senior finance editor Stefania Bianchi is following the story for us. Stefania, what does a revamp actually mean?
Well, as we understand it, what's going to happen is that it's going to combine its individual countries' retail and commercial banking operations, and then rearrange them into 5 units. And this is going to be digital, retail and commercial, payments, wealth management, insurance, and then corporate and investment banking. The idea is really to simplify the business and really drive profitability. So that's the thinking behind what's happening there.
Well, it's really interesting that we're getting all of this banking news all at once, because we had Citi talk about their revamp last week as well. Again, simplifying management, potential job cuts, a lot of the same language being used there. Are there any parallels right now that perhaps we're already seeing?
That's right. As you say, this comes about a week after Jane Fraser announced their own revamp of the bank at Citigroup. Again, Citi is going to have 5 units, similar to Santander. The idea with Citigroup is that she is really looking to drive up the stock price that has been really in the dumps since she joined in 2021. So a little different reason behind the strategy, whereas Santander is looking to drive up profitability. Citigroup is really thinking of the shareholders. But again, this could lead to job cuts, as the measures at Santander could also as well.
I love that you brought up the price-to-book ratio, because whereas Citi is the laggard in the U.S., here it's SocGen. It's definitely not Santander. Bloomberg Stefania Bianchi all over that story for us. We thank you, as always. I want to go to one of the major calls coming out of the banks this morning. Morgan Stanley resuming its overweight recommendation on gambling group Entain. The company's share price has struggled this year compared to rival Flutter. It comes as Entain, the owner of high street betting brands such as Ladbrokes, Coral, and BetMGM, is facing ongoing regulatory pressure alongside the rest of the industry. Joining me now, I'm pleased to say, is the chief executive of the company, Jette Nygaard-Andersen. Thank you, as always, for joining us this morning. Let's start with growth prospects. It feels very easy right now to talk about technology broadly, but sports betting in particular in the context of AI. Talk to us about your plans for AI in terms of your growth strategy.
I think AI is going to be a significant opportunity for many industries, and it certainly is for us. So when I think about AI and the opportunities, it's really around personalization. So for us, AI will allow us to target the right customer at the right time with the right bet. And we can fast forward that and think broader around it. Can we use both generative AI as well as conversational AI to really personalize that experience for the customer. And then you can think about automation of the front end, automation of MarTech and CRM and developer productivity. Now, we've been working with both machine learning and AIs for some time now. So both when it comes to our networks operation, that's more on the efficiency side, but also when it comes to player protection. And I think that's really where we set ourselves apart. So we've invested a lot of resources into building our own technology to protect customers that play with us. And that's driven by AI, which means that we can actually roll out a personalized safety net for you as a player. It's real time, it's proactive. And I think for the future, that's the best way to protect customers.
Well, AI, of course, being on the topic of a lot of media companies, it doesn't just come to the gaming sector, it comes to broader Hollywood as well, which brings me to one of the major, perhaps, partnerships that I'm curious if it worries you. Disney partnering with Penn Gaming, in particular, their ESPN business. How does that affect you, if at all? Does it inspire you to perhaps partner with a bigger media company? What do you think?
So in the US, we are a top player. We built that business from a standing start just 4 years ago when suddenly the states could legalize sports betting and iGaming. And since then, we've really seen a lot of consolidation in the top. So the top 3 players, and we're among the top 3 players in the US, have been sitting on around 80% of the market share. And that just tells you a little bit about the market. It's very complicated what we do. We are technology and data-driven companies, and we're also entertainment companies. So there's been a lot of consolidation already happening in the market. But listen, competition is not new for us. We see that every single day. And while we have a couple of new players now entering the market, we've also seen 2 free players actually leave the market. It just proves how difficult this is, how much capabilities that you need to have on board, and the scale of operation in order to provide great products for your customers.
Well, you hit on a key issue there. The regulation is really a key point of kind of the growth prospects there that I think you're starting to see take over the world. But on that topic of partnerships, you're already in a partnership with MGM specifically. We know that MGM has already tried to make a bid for your company as well, which has been rejected. DraftKings as well. I think the idea behind the rejections, correct me if I'm wrong, was that perhaps you could grow a little bit more on your own. But if you look at the way the valuations are functioning, you're not there yet. Why do you think that is?
So the stock market this year has been quite lackluster, and we've taken some pain from that. But listen, the growth opportunities in this business is just enormous. But it was also clear when I joined as a CEO that in order for us to capitalize on those growth opportunities going forward, we needed to make some changes to the business. First and foremost, we put a new strategy in place, which is all about growth, so we know exactly where and how we want to grow going forward. But what we also did was we put sustainability at the core of our strategy. And we're quite unique in the industry. We're the only global operator that's taken that step, and that has seen us exit a number of markets. Just this year, we've exited 10 markets. The years before, a number of markets we've exited, and really leaning into sustainability. And for us, that means being a responsible operator. We're only going to operate in regulated markets. We're the only global operators that said we're only going to operate regulated and regulating markets. So there's some pain we're taking from that, but that will flow through the business as these regulatory pressures ease, and we'll lean into our growth opportunities.
You know, it's interesting that you talk about sustainability, and as admirable as that approach is on paper, if you look at it from a market judgment perspective, your main rival Flutter is not having those same pressures. Do you foresee the strategy really encapsulating Flutter or competing more aggressively with them in the long term?
So I think just starting with sustainability, we fundamentally believe that being the most sustainable company in our industry is also going to lead to being the most successful. And why is that? Well, it gives you better quality of earnings, and it also gives you better visibility as you operate in regulated markets.
But under what time frame, might I add?
But it's going on at the moment. And you will see more and more countries actually regulate. So we are almost 100% regulated now. The biggest markets that are implementing new regulations in where we operate is the UK, as you're aware. It's Germany, and Brazil is also coming up. So that's all within this time frame. We have the new white paper out when it comes to the UK. We're having consultations. So you will see that new regulation come into place beginning of next year. That should hopefully create a level playing field for operators. So we are very confident that leaning into being a responsible operator is not only the right thing to do in protecting our customers, but it will also lead to being the most successful in the industry. And then, of course, there's some of the growth growth markets that we are leaning more into. US is a huge opportunity for us. We're number one in iGaming, but we're number 3 in sports betting, and we want to, take market share there. So we've done a number of both investments and changes to our product and our technology, really enable us to take more market share here.
Well, it seems like the next logical step then is to IPO, to debut on the U.S. markets. Do you think you will, or even BetMGM specifically, especially right now when the IPO market is picking up a little bit of steam?
So for us right now, the opportunity is so big in the U.S. So we, together with our partners, MGM Resorts, we are fully focused on the opportunities that we have in the U.S. So as I said, we have enormous opportunity to grow our market share when it comes to sports betting. We just rolled out a new app. We've acquired a company that will see us have in-house the full suite of specific products on something called single game parlay and derivatives and so forth. So as parents of the company, we're focused on really capitalizing on that opportunity. The company grew 55% the first half of this year. We are on track to deliver revenues in the top end of our guidance.
Let me interrupt you right there, if you don't mind. These sound great, and it's true. The growth prospects in the U.S. are enormous from Entain. It feels like to capitalize on the growth prospects that you're talking about, you need funding to get there. Isn't an IPO the fastest way to get that? Why not IPO?
So the great thing about the partnership that we have with MGM is that both of us have capital to invest in BetMGM, and we're fully focused on maximizing that opportunity. Now, how it will look in the future, that's something that we'll talk about, but for now, the opportunity is there to make sure that we grow the business in the US. And by the way, from a standing start 4 years ago, we're on track to becoming profitable in the second half. You don't see many businesses have grown revenues to $2 billion, becoming profitable just in 4 years. So that's really what we're focusing on now.
So you are open, very quickly, you are open to an IPO down the road?
So listen, everything is on the table, but it's not for now. Now we are very focused on making sure that we can make BetMGM the best it can ever be, and by that also come growing its market share.
A pleasure to have you on the show, and hopefully you'll give us your first interview if you do indeed choose to make that step. Jette Nygaard-Andersen, the chief executive over at Entain, joining us right here on Bloomberg Television. We thank you as always. Coming up, we stick with the story in the U.S. The UAW union warning its U.S. car plant that strikes could be expanded on Friday unless there's serious progress in negotiations. We'll bring you the latest next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta. Chevron CEO Mike Wirth says oil prices may soon reach the $100 mark, all thanks to tightening supplies. But he told Bloomberg he's confident that the global economy can withstand such a price spike. Take a listen.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. And we've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile, and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith.
Chevron CEO Mike Wirtz speaking to Bloomberg's Guy Johnson and Alex Steele there. Let's get the latest on the car worker strike action, at least stateside. United Auto Workers Union says it will expand its strike at the big three automakers at noon this Friday if serious progress is not made on the negotiations. Bloomberg's Oliver Crook joins us now. He's been following the story. Ollie, bring us the latest here. Has any progress actually been made?
Creedy, not really. So we're really deadlocked at that 20% figure that Stellantis, Ford, and GM put forward to the United Auto Workers Union, and that was a no-go. We got that yesterday in very plain terms, and what the president is now saying, Sean Fain, that the ball is in their court and they need to come up with something better, and they need to do it basically before Friday because, as you mentioned, they're going to expand that strike potentially at noon on Friday if they don't get something substantially better. And remember, less than 10% of this union is currently on strike. That means that you have 150,000 workers that potentially could step out, and that would basically bring the big three to their knees and completely paralyze operations in North America.
It's so striking to me how quickly this is spreading because really this has been, I think, the third or fourth type of labor story we saw in the U.S. Hollywood, pilots, Teamsters, and now the UAW. Now this is turning into an international story.
Absolutely. Just over the river from Detroit into Canada, Ford has 3 facilities. They've got an assembly plant and 2 engine factories. And the workers there are currently, right now, in negotiations with Ford. Their contracts expired at midnight. They have extended that window of 24 hours for those negotiations, saying that they've gotten a substantive offer from Ford. And so they are considering it now. So maybe there's some progress being made there. But it's all about the same themes, right? It's about wages, it's about pensions, and it's about reassurances around the EV transition, which is really worrying workers, but companies alike. And if they do go on strike, that could impact the V8 engines that go into the Ford F-150s and into the Mustangs.
Well, talk to us about the margins of that, because in theory, it feels like if you do start to see a lot of those cars that you just laid out hit, less supply, more demand equals higher prices. Talk to us about the margins for some of these car makers. Where does the pressure come from?
Yeah, well, the unions are referencing the profitability of these car companies, which have been higher because there have been so much pent-up demand and so much that has had to get worked through. But for these legacy automakers, there are a lot of issues ahead. And when you look at the actual cost of labor per hour on average for the big three versus some others, it's pretty interesting. It's about $66 an hour for the big three. If you look at Tesla, it does not use union labor. On average, that's about $45. If they were to meet all of the demands, the initial demands of the union, that number would go to $136. So really, in the EV transition, competitiveness is right at the center of the conversation, and not just for the U.S. automakers, for Mercedes. We spoke to the CEO, Ola Källenius, a little bit earlier.
We have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that, and we make adjustments as we go along. But at the same time, we look at, how can we do things better? How can we do work in a smarter way, get leaner, because the cost competition is not going to go anywhere.
And so there you have Mercedes-Benz, a luxury car company with big margins, talking about getting leaner. So this is front and center for every automaker around the planet.
I mean, the fact that how quickly this escalated is really mind-boggling. Bloomberg's Oliver Crook in Berlin following that story for us. We thank you, as always. Let's bring you some of the other stories we're watching from around the world, starting in India. India has rejected allegations made by Canadian Prime Minister Justin Trudeau that its government agents were behind the assassination of a prominent Sikh leader in Canada, calling them absurd. Trudeau said there are credible allegations of India's involvement in the killing of the man outside a temple in British Columbia back in June. Now over to the Middle East, Elon Musk says the Wall Street Journal's report on Tesla and Saudi Arabia holding early talks about an EV factory in the country are, quote, utterly false. The paper had reported Saudi has been trying to attract Tesla with the right to purchase certain metals and minerals needed for its EVs from countries such as the DRC. Now, coming up on the program, companies are making big bets amid rising geopolitical tensions. Today's Big Take looks at just how foreign direct investment is being influenced by politics. That conversation next. This is Bloomberg. Welcome back to the Pulse. As world leaders gather at the United Nations, a new Bloomberg economics analysis of trade and greenfield FDI data shows how geopolitical divisions are starting to shape corporate investment. Let's dive into today's Big Take with Maeva Cousin. She joins us from Zurich as a senior Euro area economist at Bloomberg Economics. Maeva, talk to us a little bit about the role that geopolitics plays here. Give us a case study, perhaps, of where we might find that influence to be more profound.
Hi, Chris. So yes, we've looked at, if you looked at earnings transcripts, companies' communication, it is clear that geopolitics are playing a bigger and bigger role in their decisions on where to invest, and decisions on how to conduct business. And take, for example, the example of semiconductors at the moment, where companies like TSMC have decided to relocate or actually to build new factories in the US, in Japan, where they used to have mostly factories in Taiwan and mainland China. So that's a concrete example of, especially for very strategic sectors like semiconductors, companies are making decisions on investment that are driven by or take into account geopolitical concerns.
But for a lot of people in a lot of countries, I would argue, it's not really having that much of an effect at all. I mean, we like to look at China as that case example, as you just said. But then you look at, say, Elon Musk, Bill Gates, Jamie Dimon, still making those trips to Asia and beyond. Is there a case here where perhaps geopolitics don't matter?
I think they are starting to matter more. It doesn't mean that that's the only decision, that's the only component of the decision, but they are starting to matter more. So what we've done is that we've looked at macro data of investment flows, especially foreign investment for new projects, for new factories. And what we found is that if you look at countries on one side of the geopolitical divide, and for the geopolitical divide, we've taken this defining event that was Russia's invasion of Ukraine and countries' decision to condemn or not to condemn this invasion at the United Nations. So if you look at countries that did not condemn the invasion of Russia at the United Nations, you can see that they have received fewer investment flows for new projects in 2022. It's particularly true, of course, for Russia. Didn't receive any investment in 2022, but it's also the case for China. So it's still porous, the border, but it's changing and it's moving.
It's fascinating to see the kind of interrelatedness, if you will, between business and geopolitics. China, Russia, you name it, you're seeing it really change the way we look at the world. Maeva Cousin, senior Euro area economist over at Bloomberg Economics. Thank you as always. Today's Big Take is on your terminal. Just type in NI Big Take Go. Check it out on Bloomberg.com. Up next, Bloomberg Brief with Danny Berger in Paris, Manus Cranny in New York. This is Bloomberg.